So welcome, everybody. Welcome to our Ship Show series. Today's January 26, 2023. And as Jason and I have always said, um, for the last 20 years, Supply Chain Solutions has really pursued a vision to deliver the future of global logistics today. We know that the world of supply chains is increasingly volatile, and we really pride ourselves on our agility and our responsiveness to develop great solutions that are sustainable and provide value for our customers. So if you could do us a favor, please don't forget to spread the word and join us each week as Jason and I unpack the emerging trends and the high-level issues that affect your supply chains. Because at Supply Chain Solutions, we deliver value quickly, affordably, and flawlessly. And it's all about the Freight Market Roundup this week, the FMR. So I think we're going to dive right into that, and we will have Jason jump right in, and we'll start talking about what's going on with global supply chain and domestic supply chain. So Jason, why don't you take it away?
Anthony, thank you so much. And good morning, good afternoon. And thank you all for joining us again on this week's Freight Market Roundup. So I can't tell you how happy I am to be back. I apologize. I was not here last week to participate. We had a little last minute family issue pop up. Everything's fine. Everything's in order. But I can't wait to break down the happenings of the world regularly to you all over the course of this year. And so I just first want to give a big shout out, obviously, to our co-host here, Anthony, for holding it down. We come from, such different angles, but I look back on our shows together and they just have this synergy that's amazing. So if you're new to us, I can't wait for you to see just how we break down the market over the course of the year. But second of all, I want to give a shout out to our Vanessa Fry, our director of marketing. And, this year we are now streaming on a whole bunch of different platforms and a whole bunch of different ways. So for instance, now we have a podcast. So if you miss our weekly updates and you want to check it out while you're in the car, shoot us an email. We'll show you where to go to get that link and how you can just listen on your drive in. So without further ado and diving right in, I want to start off by saying this, and I feel like I've been sounding like a broken record if you've been hearing me, but I swear I say this every week. There is just so many major things happening in the world of shipping right now. And we just don't have enough time to cover it all today. But Anthony and I are going to try our best. It might be another one of those shows where we're a mile wide and an inch deep, but we'll try to cover everything that's important that we're thinking about, that our customers are thinking about, and that it's just important for you to know shipping going into 2023, this week, and obviously beyond. So just to give you like a quick idea of the format, as a reminder, as we start this year, what we're going to do is we're going to walk through each of the major trade lanes. We're going to start with the Trans-Pacific lanes, then we're going to move through our transatlantic lanes. Finally, we're going to touch on our China to Europe lane. Between each of these sections, Anthony and I are going to touch on some current things we're thinking about, some major events happening in the market, and just some other overarching trends that you should be aware of or that have been kind of coming from a few months to the present time period. Finally, after that, we'll touch on air rates, what our customers have been paying, what we're seeing in that market. And then at the very end of the show, we will just quick touch on the oil and gas market, just to give you an idea where that is and where it's trending. So without further delay, let's dive right in. China to West Coast lane. Now, with the China to West Coast lane, remember, we're strictly looking at averages we've seen here on the ocean portion of the shipment. With that being said, we have kind of seen this lane hit the ground level, and it's actually been sitting there for quite a while now. So right now we're averaging around $1,300 a container, and we don't expect that to be changing much in the next coming weeks. Our averages have been trickling down from low to even lower. If you look back to the first week of December, our customers were paying roughly just $100 more per TEU than they are right now. And truly, at that time, we didn't think the rate could go any lower than it did, but obviously it went slightly lower than that. So before we dive into some of the significance of this, let's quick just discuss the experience our East Coast shippers are having. So if you're shipping from the East Asia region and you're shipping into the East Coast, as of last week, our customers were paying roughly $2,400 on average. And in comparison, to our West Coast rates, this lane has had more downward movement over the last month and a half than obviously, East Coast versus West Coast. So we started out the beginning of December, roughly 3,800. Obviously, as of last week, we're down to 2,400. In comparison, there was only about $100 drop on your West Coast lane. So, why is this? Well, obviously it's past peak season. Generally speaking, you do see a dip in rates after peak season. This year was slightly different though. Anthony, dive on in.
Yeah, and just real quick, just to add on to that, Jay. So as everyone knows, it's the year of the White Rabbit in China. It's Chinese New Year right now, and that's celebrated between January 22nd and will end with the Lantern Festival on February 5th this year. So, as a public holiday is only recognized only 7 days between January 22nd and January 29th. There's really an understanding that many suppliers and factories are really seize that opportunity to get as much freight as possible shipped before Chinese New Year. But this year is different because with the global inflation and with the way the supply chain's going right now in such a volatile market, we haven't seen that rush before Chinese New Year that we have in the past. And as Jason said, especially into Trans-Pacific eastbound, there's really only minor changes. And it's particularly with the demand surrounding the Lunar New Year. And we have seen, as Jason mentioned, a minor easing in the rates from the larger ocean carriers. And we're still seeing that right now, despite this being a period of the year where the blank sailings are most common. The Chinese New Year rate spikes that we've seen in the past have not occurred. It's really been avoided. So the rates remain soft in most origin destinations and combinations. Space is wide open. And when you think about capacity and equipment, again, that's wide open, except in a few isolated pockets on the East Coast. So we still recommend for everyone to try to at least book your cargo at least 2 weeks prior to the cargo ready date. And we're going to continue to see the carriers implement those blank sailings. But as we mentioned, or as I mentioned last week in the Ocean, the 2023 Outlook, Container Outlook, that the strategy of the container ship lines that they implemented during the pandemic of a lot of blank sailings, even though that's happening, it doesn't seem to be as effective right now as it's been in the past. Jay, back to you. I'm not sure what you're thinking about that.
Oh, no. Oh, my gosh. I mean, really, really phenomenal points and great overview. What's interesting, too, about the Chinese New Year this year is it's very unique. It's a lot earlier than it generally is. But I mean, Anthony and I can both attest in every meeting we've had this month, just the talk of not seeing a spike, which we generally see post-peak season prior to Chinese New Year. It's a every year thing. We did not see it this year. So it's very unusual. It's also definitely a symptom of the softening demand. And actually, before the holidays, we talked about a couple of things that were happening. I wasn't going to cover this today, but it's a perfect time to plug it. The National Retail Federation mentioned that just retail imports in general were going to be kind of tanking in Q1. And they were expecting a 20% year-over-year decline in February. And, we're already seeing a huge decline, obviously, in ocean shipping demand. So, we're kind of seeing this play out a little bit. But yeah.
And then just one last thing, Jay, on that real quick. When you were talking about West Coast, when we think about Canada, market and rate conditions are also very similar because Vancouver continues to see stable vessel dwell counts. Okay. Maybe 2 vessels at a time dwelling, waiting for a berth. And I would say from the time it gets in Vancouver to the time it gets to a rail, it's really only about, maybe six days or so. So the low Trans-Pacific eastbound demand is really, really further playing a key role in clearing out the West Coast portion of port and rail congestion. And Vancouver always falls into that mix because a lot of people try to bring their freight into Vancouver and then rail it down into the States. especially during the peak of the pandemic. But I just wanted to add that little tidbit there, Jay.
No, and honestly, you highlight a really good point. So, obviously we don't want to see an economic slowdown. Obviously, we don't want to see a recession. Obviously, we don't want inflation, right? But this myriad of factors is kind of almost a necessary evil for the shipping market to reset itself. I mean, we were on a runaway market, and without something major happening, the new norms would have been set too high, if that makes sense. Right now, we're sitting below cost in a lot of lanes, and it's a healthy kind of cleansing for some of these ocean shipping alliances and huge just ocean companies that were essentially price setting, but operating outside of national borders. So in a way, kind of pinning them down to specific instances was incredibly challenging. We saw that with the FMC trying to go after demurrage and detention charges. It's really hard to pin stuff on these guys. So dive into a couple things though, real quick. So as a recap, and Anthony went through a lot of this last week, but just some things to think about why this West Coast lane has just been so flat. I mean, it freaked everyone out last year. We had the West Coast longshoremen negotiations. We had the rail strike threatening, which, even had the federal government freaking out. And then we also had California stepping in and deciding it was a great time to enforce AB 5, which was right in the middle of everything. So just to throw another monkey wrench in there. And this freaked out shippers. I mean, we saw a huge shift from the West Coast to Houston and to the East Coast. And I mean, those shippers have had adequate service. And so they've continued shipping into the Houston and East Coast lanes. Now with demand drying up, it's not likely we're going to see a big shift back to the West Coast, even though the rates are the best right now in the nation. But just a couple things to consider. I want to touch on some things, Anthony, and I want you, if you just, pop your hand up too, because I know you're going to have opinions on all these, and it's some interesting stuff that we were chatting about. So Anthony was talking about the blank sailings, and there is a bunch on the docket specifically for next week. So there's 71 Trans-Pacific sailings in total next week that were normally scheduled, that were on the agenda. 31 of those are blanked out. That is a nearly 50% reduction in Trans-Pacific capacity. It's mind-blowing. And its effect on rates for the West Coast is nil. We're seeing just the most stable rate we've seen in years. So just to kind of keep that in mind, and ocean carriers are really trying to figure out what they can do and what levers they can pull to kind of bring some stability back. But they were a little challenging to work with over the past few years. And, some shippers wised up, changed their sourcing partners. Some of them came a little bit closer, came to Mexico, reducing some of the demand they'll ever get back. So it's just a couple of these things they've got to navigate. Now, kind of mentioning that, over the past few years, there has been this mounting shift away from China for a variety of reasons. But some of the signs of these companies shifting to other markets are starting to take effect. So a good example, still relying on our ocean shippers heavily, but Vietnam saw this massive surge in deep sea vessel capacity requirements. So they had a roughly 3.4 million TEUs of deep sea capacity come through their ports in the fourth quarter of last year. And just to give you an idea, that is a 21% increase year over year.
It's mind-blowing.
That's mind-blowing, especially when we're talking about this reduction in just demand in general. You've got this massive shift going into Vietnam. So keep that in mind. Another huge piece of news is this breakup of the alliance that was announced. The two alliance, the two biggest guys in the shipping game, they're breaking up. That's Maersk and MSC. It's been Anthony, you're going to have to correct me. It's been a 10-year agreement, or it's going to be a 10-year agreement by 2025?
It's going to be a 10-year agreement by 2025. And so they're part of the 2M Alliance. Okay. So as Jason said, Maersk and MSC will be leaving. So I think we're going to continue to see a fracturing of some of these alliances as we move in, through the next couple of years. So, yeah.
I wanted to kind of talk about this because I think we should do a show on this in general, because I think on the surface, we see these alliance fractures as a good thing. But then if you start to think about some of the strategies these guys have been doing on their own, you've got a lot of these ocean vessel operators who have been, putting huge investments in certain areas, in certain ports, and they're kind of digging out territory in their own spots, if that makes sense. So in theory, sometimes the alliance was almost a better situation for the shipper, but we'll see. Right now, these are the two largest. MSC has grown just an astonishing amount over the last couple of years. They had the largest order book for new vessels out of any of the other carriers. They went from almost being tied with Maersk to being roughly 30% larger, at least by the end of this year, in capacity. So it's it's the big guys leaving.
Absolutely.
So let's move on. Let's go on to the transatlantic lanes. Let's talk about those a little bit. So remember, when we're talking about these ocean lane rates, we are specifically looking at the ocean portion. Now, if you're shipping and you're leaving Europe and you're heading into the US East Coast, we're seeing the same slump in rates that the rest of the world is experiencing, but it's happening in its own unique and different fashion. So a little bit of idea of timeline on how these rates have been heading downwards. Last week, if you're shipping into the US East Coast from Europe, our customers were averaging $4,600. The week prior, they were averaging $5,500. So a pretty big swing over the course of 1 week. There's obviously a lot of instability happening in this lane, and it's been, it's been higher than most of the other lanes in the market for the past few months now. And there's now a clear downward trend, but there are a few things you should kind of be paying attention to. So if you've been shipping this lane at the beginning of December, you were paying roughly $6,500. To kind of put that in context, before the chaos happened, just over the summer with the mass exodus of shippers out of the West Coast and going into the East Coast and obviously Houston, the number that was considered this like glass ceiling, extremely high for Europe to US was 7,500. That was massive. Just at the beginning of December, we were looking at 6,500 as the rate coming in. That's still quite astonishingly high. Anthony, dive on in.
Yeah, no, I mean, I think you're spot on. I just wanted to add, when you think about that, Europe to North America, that westbound traffic, I mean, we know that the space is available to both the US East Coast and West Coast ports, because the congestion has really, improved markedly, and more capacity has entered the market. And, as Jason just mentioned, MSC and Maersk, part of the 2M Alliance, have announced that even more capacity is set to enter the market on their North Europe and Mediterranean to North American services, even though they will both be leaving that alliance by the end of 2025. And, we still see the rates continuing their downward trend as capacity has increased and the demand dips into negative territory. And really, rates are set to decrease in the coming months again. So, I mean, when we think about space, it's becoming more available due to the easing port congestion on the East Coast, and in the West Coast is becoming more available. And really, I think capacity and equipment is getting a little bit better too. Equipment availability is getting better as congestion eases. Low empty stacks in inland depots are also getting better in some specific areas, but it's really also important to prioritize the pickups from the port of loading if possible, so you don't run into any issues. And then again, we want to recommend that you still need to book 2 to 3 weeks out prior to the cargo ready date. And sometimes you may want to request a premium service for higher reliability and no roll situations where your shipment's not getting rolled, because even though things are clearing up, okay, the carriers are finding ways to throw a wrench into things, to clog it up again, to drive up that price. So we're in a crazy situation right now.
Yeah, Anthony, really good point. The I still think what's so fascinating about this is just that it's most of the lanes right now in the world, most of the major shipping lanes, they're operating at or below cost, except for this one. And that's a little bit of a red flag. Do expect this lane to be dropping though. I mean, we've seen it pretty much across the board. There is one of the lanes we're going to touch on, which is doing something slightly different, but we'll talk about that in a moment. Anthony, any major news you want to talk about when it comes to European ports and terminals?
Well, I mean, when we think about the European ports and terminals, when we're still seeing a lot of congestions, particularly in Italy, particularly in Germany, there's still a lot of, void sailings and port omissions. Germany is still a hot mess, especially in Hamburg and Bremerhaven. Um, so it's one of those things. It's about having the right relationships in the local environment that know how to ensure that smooth flow of the freight and the cargo and the communications through the supply chain pipeline, and having a great partner in the local environment in those areas where there is a lot of volatility right now is key, is
Mhm.
key. So, I mean, I think it's going to get better in the second half of the year, but right now things are still a little dicey coming out of the EU, just in general.
Yeah, and to kind of plug our next show we've got coming up, we do have a service, and it's been a very successful service that is out of Germany and into the US. And we're going to talk about it a little bit more next week, but it's been very valuable for a lot of our customers, particularly our LCL shippers. And if you're going forward and you're trying to kind of think about how you can control costs and really just have a steady idea of what your costs are going to be, it's a great option.
Yeah, and Jay, just real quick on that point, Jason and I are going to be unpacking the week. I think it's the February 9th ship show. Correct me if I'm wrong, Jay. It's really a case study on the value of our European consolidation program and our joint venture with our strategic partner in Germany, LLS Germany, coupled with, partnering with Supply Chain Solutions. So we have a weekly air freight consolidation moving into Chicago, and we also have weekly ocean freight consolidations moving out of Germany. So for all of our friends and partners out there who have a lot of freight coming out of Germany, this is a show you're not going to want to miss, and something you're really going to want to take advantage of, because it's gonna really be a big value driver for your company. But Jay, back to you. I don't
Nope,
want to
that was
get too far in the weeds on that one.
for sure, for sure. No, so yeah, but definitely more on that to come next week. And couple things that I'd like to do. Let's quick dive into our China to Europe lane. So this has been hilarious to me. So if you were along for the ride last year with us, I refer to this lane as Old Faithful. It's the busiest shipping lane in the world. It's got the most stops, and that's just because of its geography. And generally, it's a great barometer, in my eyes, of the global shipping demand. But we can throw all that reliability in the trash this week, because this has been an absolute nightmare and a roller coaster for the past over a month. Last week, shippers saw rates on a steady increase, and it's poweringly up from 2,900 a TEU. And this is 2 weeks ago to 3,500 last week. This is for our shippers. Now, remember, in context, the transatlantic lanes were sitting painfully high this time last year at 7,500, and this lane, this is the China to Europe shipping lane. This time last year, the lane was around 14,000, so it's substantially lower. But this lane is on the rise in cost right now. Now, this rising, and if you look over the past just 2 months, it's just been up and down and all over the place, huge swings, something we normally do not see with the shipping lane. Normally there's a lot of stability. We were watching the West Coast lane skyrocket in the beginning of all the congestion and such, and while the China to Europe shipping lane was very high, obviously 14,000 compared to right now the 2,900, it wasn't moving in the same speed or just momentum that these other lanes were. So it was kind of a good Old Faithful. Couple things that are happening that you should keep your eye on, and this is happening just in the regions around as well. So we mentioned about the TUM Alliance splitting up. Well, Hapag-Lloyd is making some pretty big investments in India right now. So they acquired a 40% stake in India's JM Baxi Ports and Logistics Limited. It's specifically an Indian port operator, and it really could be signaling a much improved experience shipping out of India going forward. So to get an idea of the scope of how big this acquisition is, JM Baxi, they operate 6 container terminals across India, and their annual throughput is around 1.6 million TEU. Now, a little deeper dive, really the consistency of the shipping in and out of India has just been a challenge for us in general over the course of the year. A lot of shippers complain about just the sheer number of port of loading emissions. They have a lot of cracks in their infrastructure, and it can be a little challenging sometimes for the regular shipper to, get service that they can rely on, even when there is space available. But this is changing right now. The rates out of India stayed elevated a little longer than the rest, but they came down in a pretty big way in the past couple months. Now we're looking at rates averaging around 2,200 out of India and into the West Coast, and around a little over 3,000. This is obviously depending on which region you're coming from. So it's a pretty big average. There's a pretty big deviation in there, but it's a huge decline from a few months ago, and it is a big signal that things are actively changing right now. Anthony, anything you want to mention on our China to Europe shipping lane or our interconnected regions?
Well, yeah, just real quick on the China to Europe, as you mentioned, space is very full, and there are considerable amounts of rollings due to the Lunar New Year, and the rates are really remaining very less stable compared to December, but are, really expected to be under pressure again after the Lunar New Year is over. So, rates were extended into January with some reductions getting ready to be implemented in February. And when we think about capacity and equipment, the capacity is full. It's what they like to call oversubscribed until the Lunar New Year is over, after which there will be a lot of open space again. But again, you really need to allow flexibility when planning your shipments due to the anticipated congestion delays from Asia to Europe, that Far East westbound. But just real quick on India and that ISC, that India subcontinent to North America trade lane, the Lunar New Year has really brought a lot of blank sailings and equipment issues, as a lack of Chinese imports results in less containers being repositioned and causes blank sailings on shared Trans-Pacific eastbound India subcontinent services, and that's a mouthful. But then again, this is expected to continue into early February. So like Jason said, we're going to continue to see a drop week over week in the pricing. Space is open because of those lack of Chinese imports. But again, it's something that we really have to keep our fingers on the pulse of, because capacity is being removed as carriers implement blank sailings. And we're starting to see this happen on services both to the East Coast and West Coast. So again, be open to procuring equipment from wet ports versus inland ports, inland container depots, as equipment deficits are really being felt in many areas. So basically what that means, if you can get some equipment right on the port versus at an inland container depot, which is a whole myriad of problems when you have to go inland to get that container, that empty container, for loading and stuffing. It can really cause a bunch of issues, but it's important to diversify your carrier strategy for coverage in case these blank sailings start to have an effect after the Lunar New Year. And that's my bid on that, Jay.
No, it's amazing. And I want to talk a little bit more about India too, because I don't want to just talk about the negatives. They have been over the course of the last year, because Anthony, you highlighted some great points that were positive. Over the course of the last year, there's been a lot of investment in India. India also set forth a lot of supply chain goals, and they have a lot more terminal throughput that's been coming online. And also a lot more technology that's kind of improving the ability to, the driver and the terminal and the ocean liner to be connected, which was obviously a problem before this. So we will see the stability of shipping out of India, and the fact that it needs to be recognized as the major trade lane that it is. It will become more substantial over the course of this next year. So it is kind of exciting, and it's definitely a lane to watch. And if you are considering shifting out of China, but staying within the region, India is a fantastic option. We also have a sourcing partner that specifies in India. So, give us a call. Now, couple things. Let's dive right into air, because we are at the line on time. Okay, real quick. If you are shipping out of Asia into the US and you are shipping via air freight, we actually did see a little bit of a good sign when it comes to demand. We saw a spike in air cargo prices all the way up to $8 a kilo, but now we're sitting around $5.50 a kilo this week. A little piece of news that happened: Amazon Air launched in India, and this is despite all of the fears of the slowdown. This is part of their greater plan to start to expand into the Asian region. This will ultimately help price stability for everyone, but it is causing actually service disruptions and such in some of their existing territories. So keep that in mind. And let's see here. If you're coming out of Europe and you're shipping into US, this is the old faithful of air. It's about $3.10 a kilo right now, and it's barely changing. It is headed upward. We did see a rise of about 5 cents a kilo this week, and we're expecting that to continue into next week. Big news happened yesterday. Berlin had a strike, and actually there was 300 takeoffs and landings that didn't happen. It affected 35,000 passengers and some air cargo as well. That, though, should be wrapping up relatively soon. We can talk about that a little bit more in the coming weeks as some of the details unfold on that. Next, if you're shipping out of South America into North America, this has actually been a relatively stable lane as well, sitting right now at 240. And if we go back to December, this lane normally has a lot more price fluctuation. Right now, it's 240 a kilo. Beginning of December, it was just under that, around 237 a kilo. So it's been very stable. If you need to be shipping from South America to North America, it's a great time. Not the lowest the lane has been, but relatively low in comparison. And speeding through all this, onto diesel for our last bit. Across the nation, we're sitting at around $4.60 a gallon for diesel. We still have a ways to go before we're at this pre-Ukraine crisis. Diesel levels were about 80 cents higher than it was this time last year, but we are making progress, and it has been slowly trending downward. Anthony, any final notes before we dismiss our LinkedIn Live guests?
No, we just want to give a shout out to all our friends on LinkedIn Live. If you have any questions, please reach out to Jason and I or Vanessa directly. We're happy to answer your questions, or you can join us on Zoom. We really appreciate everyone joining, and as usual, we have to continue to advise there's still a great deal of uncertainty ahead and major challenges to endure as we begin 2023. Some of these challenges are unforeseen at this time, and keep an eye out for our news flashes, tune into our ship show, and we recommend that you continuously review your supply chain and keep preparing for potential disruptions and volatility in the cost. We don't want to be a Debbie Downer, but we have to be realistic, and we wouldn't be doing our job if we didn't give it to our partners and our audience straight. I'm sure you would agree with that, Jason.
Oh, I would.
And I think that's it. Why don't we send it back to Vanessa and see if we have any questions, and we promise that we will put a little bit more focus on some of the U.S. domestic in our next FMR.
Awesome.
We were a little long this week. Sorry, Vanessa.
No, you are totally fine. I do have one question. Domestic is great. I got a message on LinkedIn actually asking for some domestic updates. So that's going to be a great addition for the next
Nice.
roundup. And then here I have one question. Wait, where's my question window? Here. 2,400 per TEU. We haven't been seeing those rates. How is capacity when it comes to lanes with those low rates? I guess this user was saying that they were having issues getting on the ship, on the vessel.
Like sailings can be part of that reason. Anthony, you want to dive into that a little bit more depth?
Yeah, Vanessa, could you just repeat the first part of that question again? I'm so sorry.
Yes, he was, I guess during the show, we mentioned 2,400 per TEU for one of the lanes. So he's saying that he hasn't been seeing rates that low where he's getting his quotes. Maybe you should be quoting with us. Yes. But how is capacity when it comes to lane with those low rates?
Hey, Anthony, that's our China to US East Coast lane.
Yeah, you have to remember too. I mean, there are a lot of other smaller NVOCCs. Supply Chain Solutions is one of the larger NVOCCs, non-vessel other common carriers. And we have a lot of multiple carrier and rate flexibility because of our volume and our leverage in the market. And some of the smaller people will offer below market rates just to get your business. Or some of them are charging a little more than they need to. And that's one thing about Supply Chain Solutions. We always strive to treat our clients and our partners fairly and equitably. So many shippers today have their finger on the pulse of the market conditions. And, you know, when reductions are passed through to us through our carriers, through our contracts, we pass them on to our clients because it's the right thing to do. But you really shouldn't have an issue getting a very competitive rate into the East Coast, you know, to tailor that answer specifically to that question. I think you should reach out to Jason and I. We'd be more than happy to provide some excellent pricing for you so you could get on the vessel and also reduce your cost, if that answers your question.
Yeah, we actually, I'm going to go a little bit further on that. We had a Vietnam quote coming into Charleston this week, and it was a little bit lower than that. Actually, it was at 2,100. But this was that's just the ocean portion of the shipment, doesn't include the delivery. And then also, obviously, not customs included as well. We're just looking at the container. And if you had a shipment, let's say 3 weeks ago, the rates have on this lane specifically have been a little bit more steeper decline. So we were at around 4,000 beginning of December, and now it's, you know, halved. So it's very different this week, or excuse me, last week than it was the prior weeks.
Absolutely.
Awesome. That's the only question I got for today. Thank you so much for your time, Anthony, Jason, everyone watching. Make it a great day. You guys.
Take care, guys.
Thank you, everybody.